Finally, here are a couple of graphs of historical volatility. And here the period H is 60 of 252. So it's roughly 3 months. This is roughly 3 months. Now notice that the way historical volatility is graphed, it's using the approach called moving average. In other words, one would expect that if you were using a period of 3 months, that you would only have one data point every 3 months. That from 1994 to 1996, you would have only, 8 data points. The reason we get a somewhat continuous graph is that, as you're probably familiar, that each day we calculate the volatility, the historical volatility, over the prior 60 trading days. So this is a 3-month moving average historical volatility. And even so, you can see it's quite variable. In the dark line, we're looking at the S&P 500. In the dashed line, we're looking at IBM stock prices. And one obvious observation is one expects that an individual stock, particularly a tech stock like IBM, would be more volatile than a market index like S&P. And of course, that's the case. The S&P is diversified by all of its various stock holdings, and the diversification lends itself to a lower volatility than when you're looking at a single stock where you have so much additional specific risk. So the fact that IBM is higher is not a big surprise. You'll also notice that there's a fair degree of correlation in the sense that some of the really major jumps in the S&P index are often magnified by even greater jumps in the IBM index. So, we look at periods here where you see IBM responding either like the market or even worse than the market. And this is, of course, the beta effect in general, that one expects that stocks, individual stocks, will have a beta component when the market goes up or down. They're going to move with that. But it also shows that periods of volatility are also reflected in the stock. And finally, we'll make the observation that not only is IBM or an individual stock have a greater volatility estimator than, say, a market index like the S&P 500, but the variability of that estimator is greater. If you look at how much the graph of the IBM volatilities vary, you can see that they go from a low of roughly, looks like about 18% here, and up here it looks like it's about perhaps 60% or more. So you look at the range and the variability within their periods, we could get volatility estimates that vary by 10, 20, 30 percentage points over different periods. If you look at the S&P 500, again, the entire range is significant, perhaps goes from 10% to a high of 25, 30%. But again, and looking at sub-periods, you can find relatively high and low volatility periods. So you see the challenge in looking at historical data in coming up with a prospective volatility, but it does provide insight if you were looking at pricing indexes, if you were looking to price options on indexes, on the calls and puts on the S&P index. This graph would give you some insights that there indeed are some low volatility periods when the economy is good, where there might well be, let's say, 10 to 15% volatility. But you also need to be mindful of higher volatility periods where the volatility might be 15 to 25% or even greater. You look at this period and it looks like the volatility got up to 30%. And this is on a diversified index like the S&P 500, and if we were doing option pricing on IBM, we would see that the variability of that estimate is even more. We can ignore this graph below. It reflects modeling using some econometric models, some time series models that are later in the chapter that we're not going to address.